Today we're looking at the provision for bad debts. One of the problems that many students have is that they get confused between a bad debt account and a provision for bad debt. They're actually two totally different accounts. The bad debt account, as we've discussed in previous videos, is related to someone we know will not pay us back. So we're writing it off as an expense, the money's gone. Effectively, that debtor has taken that money from your business. The provision for bad debts is an account that we set up to follow the accounting rule of prudence, where we don't overvalue our debtors in our balance sheet. The provision for bad debts is usually given to you in the exam as a percentage. And so in this particular example, we can see that the percent of provision for bad debts is 2. And what we look at then is reducing that amount from our overall debtor figure so that we are not breaking the accounting rule of prudence. In other words, we're not overestimating this 10,000. If in our experience we have 2% of debtors who won't pay us, then we need to remove 2% of 10,000, which is obviously 200. And we need to put in our balance sheet that actually our debtors are likely to be 9,800 and not as high as 10,000. So I always teach the provision for bad debts as a chest. Imagine you're putting some money aside as a provision, depending on what that percentage is for the provision for bad debts. So we open up a separate account, which is known as a provision for bad debts account. It is a completely different account to a bad debts account. And in this case, we've got $200, which is our provision for bad debts. We simply transfer that directly from our provision for bad debts on the credit side, and we debit our provision for bad debts in the profit and loss account as an expense. And note here that you've got your bad debts, so these are people we know we're definitely not going to receive the money back off. Totally different account to the provision for bad debts, which in this case is 200. And at the end of the year, we would have a balance carried down of 200, and at the beginning of next year, a balance brought down of 200. So effectively, we have put into our provision for bad debts $200. So in the second year, we have decided to keep our value of provision for bad debts at 2%. All right, so that's the number of debtors we estimate won't pay us back at the end of the year. And remember, we're doing this to stick to the accounting rule of prudence, where we don't overvalue our debtors in the balance sheet. But as can be expected, depending on our sales, our debtors figure has changed from last year's figure of 10,000, and actually we've sold more this year, and our debtors figure has risen to 12,000. Well, obviously, 2% of 12,000 is going to be a higher provision for bad debts. 2% of 12,000 is 240. Now, from last year, we had a balance carried down and brought down of 200. And if you remember, I said, imagine it's like a chest. We've put in $200, which we've bought from last year's provision. If 2% of this year's debtors is 240, effectively all we need to add to this is $40. So to get a balance carried down and brought down of 240, we would only make an entry of $40 onto the debit side of our profit and loss account. And that is actually incorrect, because that should be just 40. So we'll scrub that bit out there. And what that means is that effectively we now have 40 this year, and we have 200 from last year, which means we have a balance carried down of 240 and brought down, which means then we can represent the correct figure on our balance sheet. And so if we look at our balance sheet, just shifting this upwards slightly, then we would represent the balance sheet as follows, by having a debtors figure, which would be under your current assets. So under your current assets, you would have debtors, and you would list that as 12,000, which is this year's debtors, minus a provision for bad debts of $240, and then you would minus that figure from the 12,000, which would leave you with $11,760. And here you can see we have stuck to the accounting rule of prudence, because rather than pretending that our debtors are going to be 12,000, we've actually taken away a sensible amount for the number of debtors that don't usually pay us back, and we're saying in reality our debtors figure as a current asset is likely to be 2% lower, 760. Now if we look at the third year, our debtors figure has dropped to 10,500. We're still keeping the provision for bad debts. The number of debtors we estimate won't pay us at 2%, but 2% of 10,500 is obviously going to be a lower number of 210. So again, what we have from the previous year is $200 the first year that we've put in, $40 from last year, which gives us a total obviously of 240. But we actually only need a provision for bad debts of 210. So what we're going to have to do is to take out $30 from this chest. So the way in which we do that is we reduce the amount that has been brought down. So when you look at last year, we had a provision of 40, 200 from the previous year, which gave us a balance brought down to 240. How can I reduce this to 210? Well, I simply make a debit entry in my provision for bad debts account and a credit entry in my profit and loss account. And that then leaves me with a balance carried down of the correct figure of 210. And that's the figure that we would then put into our balance sheet. And we can see here that using the accounting rule of prudence in our balance sheet, if we look at the extract, that would give us a debtors figure of 10,500 minus 210, which is the provision that we're accounting for, and would represent a much more realistic value of our debtors of 10,290. Remember, prudence rule, we undervalue a fixed asset as opposed to overvaluing it.